Hello everyone, and welcome back to the Web3 Daily. Looking at the market today, honestly, it feels like it's entered a bit of a cooldown period. After the previous highs, the entire board is now in a state of pullback and consolidation, and the total market cap has shrunk quite a bit. I've been looking at the data, and both Bitcoin and Ethereum are currently grinding back and forth near key support levels. Trading volume has also dropped off noticeably. What does this tell us? It shows that sentiment has shifted towards caution. The previous FOMO has turned into a wait-and-see approach. Specifically for Bitcoin to bounce back today, we need to see if it can firmly hold the roughly $109,050 level. And it's not enough to just touch it. It needs to stabilize there for an hour or two for it to mean anything. If it can't even hold that position, this rebound might just be a fake out, and everyone needs to be mindful of the support levels below. Ethereum is in a similar boat. Keep an eye on the $3,948 mark. The logic is the same. Hold it, and we can look up, fail. And you have to be aware of the downside risk. Overall market risks are still present, so it's best to proceed with caution in your trades. Alright, let's switch gears and talk about something that's stirring up a ton of controversy in the space right now. When you mention Pi Network, you get some strong opinions, but love it or hate it, one of its ecosystem projects, a peer-to-peer marketplace called JPM, has been held up by the community as a major success story. They were building a 100% Pi-based economy, but just in the last day or so, the narrative got completely flipped on its head. A verified Pi community account on X dropped a bombshell, alleging that some of the so-called foreign used cars being sold on JPM, especially the ones exported to Africa, might actually be stolen vehicles. And to back it up, the post even referenced Interpol's stolen vehicle database. And that just set things off. I mean, think about it. A platform that was being celebrated as a prime example of a decentralized economy is now potentially tangled up in transnational crime. This has plunged JPM into a major crisis of confidence and cast a huge shadow over the compliance and regulatory integrity of the entire Pi network. So far, JPM hasn't made an official statement. How this whole mess gets resolved is the big drama everyone in the community has their eyes on now. Alright, moving on from that controversy, let's dive into a piece of news that's just as massive. And I think the impact of this one could be even more profound than we realize. The US government, which used to be one of the biggest potential sellers hanging over the market, has just completely flipped the script. You know how it used to be they'd seize Bitcoin and then the US marshals would auction it off, dumping a ton of selling pressure on us every time. Well, according to a new executive order, that's over. They're not selling anymore. They're taking a stash worth $14.2 billion, that's about 127,000 Bitcoin, and putting it all into a newly created strategic Bitcoin reserve. Guys, just let that sink in. Strategic reserve. That puts Bitcoin in the same category as the strategic petroleum reserve or the national gold reserve. This is the government basically telling the entire world that Bitcoin is no longer just some criminal asset to be liquidated. It's a national level strategic asset. The more immediate effect, the market just had over 100,000 coins of potential supply taken off the table, just like that. It's like that sword of Damocles that was always hanging over us has been sheathed. And get this, all future seizures will be handled the same way. This reserve is a one-way street. Coins go in, they don't come out. This fundamentally alters the long-term supply dynamics of Bitcoin. The scarcity just got a massive institutional upgrade. So think about it. On one side, you've got the US government hoarding Bitcoin at the state level. On the other, you have Wall Street absorbing it through ETFs. When you put those two forces together, isn't it clear that the fundamental structure of this market has changed for good? And don't think for a second, it's just the US government making these moves. If the government's action was a calming pill for the market, then the insane buying spree from the corporate world is like a straight shot of adrenaline. I saw the latest data from Bitwise, and corporations globally are now holding over $117 billion worth of Bitcoin. To put that in perspective, that's over 1.02 million coins. What's even crazier is that this number grew by nearly 40% in the third quarter alone. The big boss leading the charge is, of course, still MicroStrategy, Michael Saylor's company, holding over 640,000 Bitcoin. But it's no longer a one-man show. More and more public companies like MetaPlanet in Japan are aggressively adding to their positions, literally doubling their holdings. When I saw this data, my first thought was that the Saylor playbook, once seen as a gambler's move, has now been completely accepted by the mainstream. Think about it. For a public company to make such a decision, it has to go through so much scrutiny from its board and shareholders. Now that 172 companies are doing it, what does that tell you? It means treating Bitcoin as a corporate strategic reserve has become the new normal. This buying power coming from corporate balance sheets is nothing like us. Retail investors chasing pumps and dumps. Their purchases are based on long-term strategic considerations, making the capital extremely sticky. This kind of demand is like building a solid foundation for the market, effectively absorbing short-term selling pressure. So you see the pattern. On one side, the government is shrinking the supply, and on the other, corporations are expanding the demand. The fundamental logic of this market has truly changed. After talking about all these moves from big institutions and governments, let's switch gears and see how the top players on Wall Street are viewing this recent market correction. JPMorgan. Yeah, the same JPMorgan that once called Bitcoin a fraud, just put out a report that I found really interesting. Their take is that this market downturn wasn't primarily caused by something the Fed said or some new regulation from another country. Instead, they're pointing the finger right back at us, at the insiders, or as they call them, crypto-native investors. So who are these crypto-native investors? They're talking about the earliest Bitcoin adopters, the crypto VCs, the big whales in DeFi, and the professional quant trading firms. What JPMorgan's analysts likely saw was that after the market hit its recent peak, it was these very insiders, the ones who know the game best, who started closing out their long positions in the derivatives market, triggering the first wave of selling. Then, as prices fell, collateral in DeFi, lending protocols became under-collateralized, setting off a chain reaction of liquidations, a liquidation spiral that dragged the market down even further. This whole thing reveals two key trends. First, our market is genuinely maturing. It's no longer the little brother that just passively follows macroeconomic trends. It has its own internal logic, its own credit cycles, and its own leverage games. And it's now capable of generating its own large-scale volatility. Second, just look at this. A TradFi giant like JPMorgan can now produce analysis that is so in the know, so deeply insightful about our space. What does that tell you? It means they've thoroughly studied our world of on-chain data and DeFi protocols and have integrated it all into their analytical framework. The wall between traditional finance and the crypto world is being torn down, brick by brick. Meanwhile, in the United States, regulatory innovation is quietly taking place. New York City Mayor Eric Adams, this guy is a true believer. He previously converted his own salary into Bitcoin, and Ethereum has now established the nation's first municipal-level Office of Digital Assets and Blockchain. The office goal is crystal clear: to make New York City the global hub for cryptocurrency. What I find most interesting about this is that it kicks off a new, bottom-up approach to regulation. The federal folks, like the SEC, have been dragging their feet and often taking an adversarial stance, creating a lot of uncertainty for the entire industry. But now you have local governments in places like New York, Miami, and Wyoming taking the initiative themselves, competing to attract more Web3 talent and capital. This kind of local regulatory competition could eventually force the federal government to come up with a clearer and a more sensible national regulatory framework. And Mayor Adams played this very smartly by linking crypto technology to solving the problem of financial inclusion, saying it can help the underbanked. By doing this, he successfully shifted the narrative around the cryptocurrency from a speculative tool with a negative image to a positive tool for solving social issues, which dramatically improves the public perception. During a market-wide correction, someone within the Solana ecosystem is buying against the trend. I saw reports that a Solana treasury management firm called DeFi Development recently increased its holdings of SOL tokens by nearly 5%, with an average purchase price of around $110. This move, in my opinion, sends an incredibly strong signal. Think about it. Who knows the most about Solana's technical progress and future plans? Their own people, of course. When these insiders, who hold the most critical information, decide to jump in and sweep the floor with real money while the market is hesitant, that in itself is the most powerful endorsement of SOL's long-term value. It's basically telling the entire market, from our perspective, the current price is severely undervalued. Moreover, this reflects the growing sophistication of treasury management among top-tier projects. They are no longer just passively holding assets, they are actively managing their positions like a professional fund, using market volatility to optimize their holdings while injecting confidence into the entire ecosystem. This kind of buyback during a downturn not only provides price support, but also shores up morale among developers and the community. It's a beautifully executed play. Finally, let's wrap up with some great news from the Web3 application layer. And I think this is a real morale booster for the whole industry. A fintech company from Taiwan called OwlTing has officially gotten the green light for a direct listing on the Nasdaq with the ticker symbol OWLs. So what do? In short, they've built a platform called OwlPay, which helps businesses worldwide transact and make payments using stablecoins like USDC or traditional fiat currencies. The significance of this goes way beyond just another crypto-related stock hitting the market. First off, getting listed on Nasdaq is the ultimate endorsement. We all know how strict their vetting process is. The fact that OwlTing passed means their B2B payment solution built on stable coins has been validated and certified by the mainstream capital markets. It's like telling institutional investors all over the world that Web3 payments aren't just some niche experiment. It's a profitable, promising, and legitimate business model. What's more, they chose a direct listing instead of a traditional IPO. What's the difference? A direct listing, to put it simply, means the company isn't issuing new shares to raise capital. It's mainly a way for existing shareholders to cash out. What does that signal? It shows the company has healthy cash flow, they're not desperate for money, and they're extremely confident in their current valuation. This kind of move shatters the stereotype many people have of crypto startups being nothing but cash-burning machines. This isn't just a win for OwlTing. It's a powerful shot in the arm for the entire commercialization prospect of the Web3 application layer. Alright, that wraps up today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the noise to bring you the most critical and wealth-relevant news from the Web3 world. We hope that by breaking down these hand-picked stories, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped some exclusive registration links for major exchanges in the comments section below. These are special high rebate deals we've secured for our viewers, and we hope they can help you save some costs along your investment path. Let's stay rational, move forward steadily, and get rich slowly together in the world of Web3. May everyone's crypto portfolio grow steadily. We'll see you tomorrow.